We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Inflation, wealth taxes, and taxes on unrealized gains and more. Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me for this Wallet Watch episode is Chris Calandra from Elliott Wealth Management. Chris, welcome.
Thank you for having me today, Eric.
Always good to have you to talk about what's important in terms of money. And let's start off with volatility in the markets has been great, but we've actually seen a rally of late.
Yes, we have seen a rally of late. It started in early October. Currently, Eric, as of this recording, it looks like the bottom for the market was on October 12th. Since then, the fourth quarter was positive for most of the major indexes, including the Dow, S&P 500, and NASDAQ. And that encouraging uptrend has continued so far this year, with the market up in January, a healthy amount. And so far, again, as of this recording, which is in mid-February, the market is having a good month in February as well. It's not surprising to me, Eric, because the central issue that messed everything up last year was inflation. And inflation has been moderating. In June, we had inflation that was plus 9%. In September, it was well over 8%. But in December, it was 6.45%. And it was something like 7 and change in November. So I don't think it's a coincidence that the market is rallying at the same time when it seems that inflation is trending in the right direction. Still a big problem. We're not out of the woods yet, but the trend going in the right direction seems to have been enough to help get the market off the floor.
All right. And speaking of inflation, we have new consumer price index numbers out today. And inflation rose in January by 0.5%. which is up 6.4% from the same time last year. Both of those numbers are actually higher than were expected. Yes. And the super core services inflation, which is a key that the Fed uses to figure out what they're going to do with interest rates, rose 0.2% for the month and 4% higher than a year ago. And again, all of those numbers are higher than expected. So do you think that might slow the rally that we've been seeing?
It might. And I think I like that you emphasize in the question expectations, because as you and I have discussed on and off the air, a lot of this is an expectation game. So the numbers in and of themselves are not great. But to me, it's also a little worrisome that we're expecting better than what we're getting. It would be much, much better if it was flipped and we might get a bad number, but it wasn't as bad as expected, would be desirable. So it could derail the rally, although my opinion is more optimistic than a lot of folks, because I think that the trend now is still in place that the Fed, with their aggressive rate hike increase posture last year, they raised interest rates 7 times last year, and so far 1 time this year, that they're having the desired effect. And it's going to take a little time, but it's going in the right direction. So I don't think one number is going to upset the change, I think, in the attitude about inflation coming down. And the last thing I'll say before I kick it back to you is that super core number you mentioned, the 0.2% for the month. It's notable, but it's also notable that it's 4% compared to a year ago, we had been seeing numbers that were 6, 7, 8, 9s and higher in previous runs. So it is coming down year over year, which I think reinforces my thinking that the trend is now your friend with inflation coming down. It'll take some time, but going in the right direction.
Right, yeah, I think the big problem that we're going to face with these inflation numbers is that the best numbers, those super core numbers, which were much lower, exclude the costs that families see most often on a regular basis. They don't count food, they don't count gas prices, they don't count oil prices. And this is where most people see the effect of inflation.
Yeah, it's a great point, Eric. I did a call at the beginning of the year for my clients, Elliott Wealth Management Services. And then we repurposed that into my podcast, Simply Financial. So if anybody wants to listen to it, they could find it at my site, elliottwealth.com. But I made that exact point that, listen, inflation's coming down, and it probably will come down faster than a lot of people are bargaining for. But, and it's an important but, is that people may not realize it just yet, because even though inflation was at 6.45% in December, which is a good number, as I already said, compared to the previous few months, including June being +9, food still went up, shelter still went up. And that's the thing that people are being confronted with day in and day out and impacting their pocketbooks. So it is wonderful that inflation is coming down, but it's still having a very negative impact because some key parts that make up the inflation number are still going up. In contrast, energy prices have come down a lot. And that was a big, big component of why the inflation numbers have been better. And that does help people, but they're still very aware and irritated by food prices going up. But energy has helped a bit, and people do see that in their daily lives. Fill up your gas tank at the gas station, and you're probably paying less than you did a year ago, roughly.
Absolutely. And of course, not all money is real money, at least according to a number of states and prominent Democrats who are pushing what they call wealth taxes. They actually want to tax you on money you haven't gotten. So can you explain to our listeners what a wealth tax is?
I will do my best, but listeners, please know that this makes no sense to me whatsoever. Yep. There's a lot of policy that I generally disagree with. I am quick to criticize generally, but this is just bananas. So the Biden tax proposal, which is probably dead on arrival, it does not have widespread support. It doesn't even have a ton of support even within the Democratic caucus, I don't think.
No, you're right about that. A number of Democrats have already said, no, this proposal's dead on arrival. They didn't have the votes to get it through when they controlled both houses. Now with a Republican-controlled House, there's no way for them to do it.
Yes, but I think you agree, Eric, and this is why it's worth talking about and educating people and having it in the public dialogue, is that it might not work this time, but they'll come back to the well. They'll come back and they'll try it and they'll try it and try it until they get their way. And so the best way to defeat this, if it is in fact bad policy, like I think it is to really defeat it very handily early on, making future fights perhaps easier. But let's just catch everybody up. The way the current tax code is structured today, let's say you buy an investment for $10,000. It could be a stock, a bond, a mutual fund. It could be a stake in a business. It could be real estate. It could be a collectible comic, whatever. You put $10,000 into it. And then let's say you look a few years later and you've done well with the investment. And now if you wanted to sell it, you could sell it for $30,000. So now on paper, you've made $20,000. You have something an investment of some sort that you paid $10,000 for, and now it's worth $30,000. Under the current policy, and this has been like this forever throughout US history, you did not pay taxes while it went from $10,000 to $30,000. It's what's called an unrealized gain. You own it, it's appreciated, but there's no taxable event because the position, the investment, has not transacted. It has not been sold. So the policy prescription for the Biden administration and some of the more liberal, progressive elements of the Democratic Party want to make that $20,000 unrealized gain taxable, so that you bought something at 10, it's worth 30, you're still just holding it, and then they'll send you a tax bill for the $20,000 that you made. The trick is, of course, and you don't have to be an Harvard MBA to figure this out, that $20,000 gain may not be real, because you may not actually be able to get that if you sold it, or it may be valued at that day at that price, but a month or a year or 3 years later, it could come down, and then you would have paid taxes on something that later on will be worth less. It's very, very messy. Additionally, and we could talk about all of the things that are wrong with this, but it would put a lot of liquidity pressure in the marketplace. Because if you own a business and you build a business and that business grows and becomes more valuable, you don't necessarily have the cash to pay the taxes on the appreciation without selling the business or selling part of the business. The same thing if you own a property or a farm or a lot of different things that are not as liquid as stocks, bonds, mutual funds, and the like. So you would have a lot of situations where you would have forced selling, where somebody's simply selling stuff so they could pay the taxes on the gain, and that would be a major distortion in the marketplace, because then you have a lot of economic activity that's not based on economics, but based on tax bills. Did I explain that okay, Eric?
Yes, you did. And I think the most important thing to make sure that our listeners understand is that the taxes of this would be coming due before you actually made the money.
That's right.
So, yeah. So now let's look at stocks for a moment. Let's assume this went through. And by the way, even though it's dead in Congress, several states are still trying to push this through.
Yes.
My favorite proposal is California's, where they want to tax you even after you've left the state. But let's look at stocks. If you have to suddenly sell off part of your stock portfolio to pay the taxes because you don't have the cash, because you haven't actually made the money, what's that gonna do to market volatility?
It's going to increase market volatility based on what I think is an artificial external event like tax policy. Markets are going to go up and down and sell off, but you want it to be a pure version of economic activity, and taxation would be an unwelcome distortion. But at least, Eric, at least in that instance, those vehicles tend to be more liquid. There are a lot of other investments where people, everyday Americans, as well as wealthy Americans, will accumulate unrealized gains. And it's not easy to sell those positions or those investments. That means then they might have, take an example of a business that, let's say they put 100,000 into business and they do really well and the business is worth $2 million, right? And then you get the tax bill for that $1.9 million. Well, you can't get it from the business, right? So that means you might have to go into the markets to sell to pay the taxes that are due on the business. That's where you get a lot of distortions, not just having to sell stock to pay the taxes due on the stock, but what about having to sell stock to pay taxes on a business or an investment or some other asset that has nothing to do with the stock market? That's really where you get a complete perversion of economics.
Absolutely. It's also important for people to realize that this could affect your 401k, your IRA. possibly even your pension, depending on how the tax rules are set up. But I think an example that should frighten everybody is this could also apply to the value of your home.
Yes.
And let's face it, most people are not in a position where they can go, oh my God, I have to sell my house to pay the taxes.
Yes. Yeah. And perhaps they would exclude the home, but how many people do we know in Connecticut, our neighbors, friends, coworkers, and the like, that have done well? They're not the Elon Musks of the world, but they might have a vacation home or an investment property, a second home in Florida, or maybe at the Jersey Shore, the Rhode Island shore. That's very likely because that's an investment. So then you would, you might have done well on those investments over the last couple of years as they appreciated in value. Imagine you had a second home at the shore that you paid $250,000 for, and now it's worth $750,000. You're really, really happy, and then you get a tax bill for a $500,000 gain.
Exactly. The core of this is they want to tax money that you don't already have, and that's the raw naked truth. Thanks for being with us, Chris. You can catch every episode of The Raw Naked Truth and Simply Financial at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and other platforms that respect freedom of speech. We'll see you next time.